All right. Good morning, everyone. This is David Moore with Equity Advantage, and today's seminar is Advanced 1031 Exchanges, the fun stuff. I'm just going to start off by saying if you haven't been to a regular presentation, one of our introductory ones, or even just one of our monthly presentations, it's going to be some things that we're probably going to have you swimming in. And the only dumb question is the one you don't ask. So we've got more than an hour's worth of material. I'm going to probably cover it very quickly. If you've got questions, there's a section on the right side menu that has a portion for questions. We probably will not be addressing them during the presentation. We'll be responding back to them afterwards. If you are in a state where we can offer real estate continuing education, please reach out to Celia Moore, cmoore@1031exchange.com, CMOORE@1031exchange.com. And I just want to thank everyone for participating today. This is a class that first time I've done this particular one, but I always have a good time talking about this after more than 30 years of time in the business. You'd think maybe get tired of some of the topics, but this is a class that I have a good time with just because we're combining a few different things. I'm going to actually throw in some information, some transactions where we're combining IRA 401k funds with the 1031 transactions. I think we've got a slide where we're talking about bailing something out too. But this is something that is sort of, obviously well beyond basic 1031 information. We're going to talk about reverses, improvement exchanges. We're going to talk about seller finance, partnerships, and I believe we've got some information on second homes in there too. We'll finish up with some examples, but I think that I hope you're going to get some good information out of it. And I always like to say they're little nuggets of knowledge. One little thing can open a door. And one of the greatest things about this business, I think, is we're helping people. We're giving people that olive branch to the future that maybe they were told they didn't have or didn't think they had. So, if you've got questions or concerns, I believe we've got a couple people on this presentation that are also in the biz and longtime biz, and they would probably say the same thing that even after more than 100 years, we get calls after transactions closed. If you're wanting to do an exchange, don't let anything close before you talk to us. All right, because it's just as soon as something closes, it's too late. If we're doing a reverse exchange and you've closed on it before we're involved, that's too late. If you have actual or constructive receipt of the proceeds on a disposition, it's too late. So the biggest issue with any exchange is going to be time. The best way to deal with that time issue is to ask for whatever time you feel you need to get transactions done. We are in a crazy world right now, and there's very few contingent sales, and people are not willing to wait. But hey, it's your job to ask, and if you don't ask, the answer is always no. So ask for that time, do what you can. When we're getting to the reverse section, I'm probably going to talk about things, use that as a fallback. Don't use it primarily as a first course of action, just because financing's tougher and the costs go up dramatically too. But we're going to try to talk you through this stuff, teach you how to do some things. And we also, one other issue we're going to talk about is holding periods, and we'll talk about dealer status with those holding periods. And in COVID holding periods, especially in different states. I mean, if we're looking at California, Oregon, definitely, where we've got governors basically just saying, hey, the tenants don't have to pay anybody. And we might have just had a client buy a property just a year ago. Could you imagine if you bought your first rental property a year ago and now you're having to deal with this stuff? I heard a story the other day that was very distressing. It was a kid, 25-year-old kid, had gotten inheritance, and how many 25-year-olds are going to get inheritance to do the right thing? So what did he do? He went out and bought a duplex, and he was going to, he lived in half of it, and guess what? The tenant in the other half is not paying, and now this kid that did everything right is in a bad spot. So don't let anyone tell you that 1031 says it's got a 2-year required hold. It does not. It's really totally discretionary between you and your tax people. While I'm on that topic, we're just one member of a successful team of investment professionals. I'm going to put your tax people probably at the top of that heap. And don't call them up April 14th with questions. Call them up before you ever sell something. Call them up when you're contemplating a sale, so you understand what the tax liability is going to be on something that you're giving up. But let them know what's going on in your life, and they're going to help you out. And if it's a situation where you're just using it for tax returns, it's hard for them to do anything really proactively, obviously. So we're going to have good title escrow people, obviously brokers that understand the process, understand the timing on these things, finance people, property managers. The property management is, I believe, getting to be a bigger and bigger issue for people, especially in high rent control areas, because the issues, the liability of owning real estate these days gets higher and higher. And unless you've got somebody watching and staying on top of all those laws, it's really one of those things where management is just going to be a bigger and bigger issue for everybody, even rental houses going forward, I believe. But with that said, happy St. Patty's Day to everybody, and away we go. One comment, bottom of this first page: you've worked hard for your money. We work hard to keep it yours. We're looking at 1031's tax deferral. All right, you're going to choose to defer the tax for as long as you choose to defer it. You don't get rid of tax exposure. The only way you're going to get rid of tax exposure is by swapping till you drop, and that's something we will talk about because that's sort of on the chopping block. But the idea is use this stuff. I look at 1031 sort of. You're looking at tax money growing tax deferred or potentially tax free. It's like a Roth IRA, but you're doing things with it. You've got all the benefits of ownership during this period of time. Our sister company, and like I said, I've been in the business for more than 30 years now, and you're in a situation where we had for years clients wanting to diversify outside of Wall Street's offerings with their retirement accounts, and a dozen years ago or so we put a company, IRA Advantage, a sister company that handles self-directed retirement accounts. We're actually going to talk about some joint transactions during the presentation today where we're combining qualified money IRA 401k funds along with 1031 funds. So, I like, there's another presentation I give. It's titled, You Can Do What You Don't Know, and I really enjoy that one. I presented that to the CCIM Global Conference 2 years ago now. But it's a lot of fun because it's the whole purpose of that one's just sort of open people's eyes. But here we go. So first thing we just want to talk about, and we did a presentation last month on this topic. We were blessed to have people from Inland Private Capital speaking. They're Chief of Governmental Affairs, and it's very well received presentation. And we were talking about what had been proposed with Biden pre-COVID, and everything's changed really. I mean, you look at it, you look at what's important. Obviously, health and welfare is the biggest thing right now. And we were looking at a situation where just a month ago we were thinking, hey, everything's going to sit tight for a while. The idea was that these proposals were pre-COVID, the world's a different place than when they first came out, and that we'd have all the health and immigration issues to deal with the first year, and then tax reform might come in the second year. But the idea was we don't probably expect a lot of change in that second year because of the midterm elections and the Dems' desire to maintain control of all three branches. Well, here we are. Yesterday we're talking about taxes and what's going on there. So who knows what's out there. We have not heard more on 1031 going away, but at the bottom of this page, we need all the help we can get. 1031 is 100 years old, but it's a situation where every time a new group of politicians gets elected, I wish they'd talk to the previous group because they throw out the same proposals. And then we have to jump back into it. And the FEA, Federation of Exchange Accommodators, has some trade partners, and they did a white paper on it. And it was pretty clear that if 1031 goes away, it's going to end up costing the government taxes. It's not going to generate more for them. But we got to stay on top of this stuff. Reach out to the 1031taxreform.com. It's part of the Federation of Exchange Accommodators, and obviously we can use all the help we can get. So what are they talking about? When we're looking at 1031, they're looking at either elimination or modification. I'm more concerned with modification than elimination. If we go back to Trump's tax reform, we lost personal property exchanges. And I think the reason we lost personal property exchanges is they wanted to create the opportunity zone, and opportunity zones are not an alternative 1031. I mean, if you're going real estate to real estate, there's just so many reasons to do 1031 over an OZ. But OZs are a great end game. We also did a presentation last month on end games and talked about a whole variety of them. Take a look at our YouTube channel. Just type in Equity Advantage 1031 exchanges, and there's videos on all kinds of different topics. If you want IRA 401k information, you can go take a look at IRAadvantage.net.com, and you type that in on YouTube. But we're looking at modifications, a bigger issue. We lost personal property in 2017, and understand that what they had proposed is maybe that if you had made more than $400,000 a year, you wouldn't be able to use 1031. Or now there's another proposal out there that you would be able to exclude gains up to $1 million in that. So I can see where the politicians are getting very good at splitting us up, making us fight against each other right now. And I can see a situation where a lot of people that don't make that much say, I don't care, I don't make that much, doesn't impact me. Well, remember, at some point it will, and ultimately it does. But elimination or modification is out there. It's being talked about, not seriously right now, but at least that we're aware of. Elimination of the stepped up basis. This is one of those things that in 2017, we were talking about. Once again, sort of looked at it, said, hey, don't talk about it too much, but this is a big one. Imagine you're a family, and I always throw back to the farmers. You've got people that are land rich, cash poor, and just imagine the patriarch or matriarch passes away, and now the farm's got to go to the next generation. And you look at what they're also trying to do with the state taxes, and increase their tax revenues on those, probably decreasing the exclusions on that stuff. And you're in a situation where you paid tax on the money when you bought it, you paid taxes on the asset the whole time you owned it, you paid tax on everything you bought primarily to use in it, and then when somebody passes away, you got to pay tax again on that, and that's just a horrible situation. And it's a situation where I can imagine, actually based on in history, where the next gen can't afford to keep what the previous gen had, and that's just I don't believe that's something that is at all in the spirit of America. Increased long-term capital gains tax rate. So there's a big argument, hey, they want to bring it back to normal income tax. Why is this fair? Da 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 da. So if you look at our business, and I would bet anybody in the exchange business right now, if you're in real estate, you're probably busy. We are buried. I'm trying to get through emails from last week right now, taking care of transactions and people. And it's a lot of it, I think, is because people are trying to get stuff done sooner rather than later. They don't know what's around the corner, and they want to take care of it. So, the old saying, use it or lose it. Just keep your ear to the ground. If you want updates on this stuff, please sign up for our newsletters, and we'll get information out as soon as we've got it. And as I said, we can use all the help we can get, making sure we keep this intact. And if you think about real estate and what it's done, how it's worked for people, if you look at Wall Street, you've got trillions of dollars worth of money on Wall Street that's all qualified IRA 401k money. That stuff's an automatic rollover. If you take 1031 away, only 2% of IRA 401k funds are in real property, and that's I would bet a bulk of that is in real estate investment trusts. So if you take 1031 away from real estate, it's going to be very, very damaging. We don't have for the most part, people using qualified money to buy real estate. I'm happy to help anybody out there that wants to do that. Love to have all of you do it. But the reality is 1031's been a fixture of the real estate investment world for more than 100 years. It's an excellent tool. It's a tool for the everyday person. You don't have to have big high dollar tax and legal work done to do an exchange. I mean, an exchange is going to cost you $1,000 to $1,500 for a basic delayed exchange. And it's a wonderful tool for anybody out there, and it's not something that you got to, like I said, spend a fortune getting done. And a lot of times this is a deal. I've got so many clients that through their life they started off with a single house and built it into another one, then they went into plexes, apartment buildings, and ultimately end up into industrial or retail, and finally at the end of the day they end up in a DST or TIC, something like that. But our ability, in some ways, to me, it sort of looks like the politicians don't necessarily want individuals buying real estate for investment. So anyway, we don't want it all to fall to the REITs and just the people with the deep pockets, because You know, that's what's happening. You look at some of the rent control rules that we have to deal with in Oregon, for example, and a situation where new buildings are exempted from some of the rent control issues, and the old ones are subject to it. The old ones are the value add situations. They're the ones that need the money pumped into them. And now there's a proposal out there that would actually you know, tie a property owner's hands in between tenants. I mean, you've got restrictions on how much you can raise rent for a tenant, but now there's a proposal that you wouldn't be able to allow, or you would not be able to raise your rents to a current market value if you put money into that thing in between tenants. So it's really crazy. I don't know how, you know, these people that are making these rules don't even, in Oregon, for example, some of them don't even own their own home. So they don't know what it costs to maintain something somebody cares about, let alone something nobody cares about. I'll get off my soapbox. You're not on here to listen to me vent on that stuff right now, but I just want you to be aware there are things out there, and we've got to keep our ear to the ground, make sure we're on top of what's happening, and we don't lose something before we know it was up there to be lost. So why real estate today? Well, we all hear ads on gold and silver every morning, every night, see it on TV, hear it on the radio. What are they selling? Tangible assets, inflationary hedges. What's real estate? Tangible asset, inflationary hedge. I got into 1031s from the investment side. The gentleman that taught me real estate investment taught me never to bank on appreciation. He wanted me to bank on, you know, how to make something, make value, create value, value add situations. So, you know, I want to take the risk out of it. What are you going to make? How are you going to make it? When are you going to make it? If you can't answer those questions, don't buy it. If you've been on my presentations before, you've heard me say that stuff. But real estate doesn't have to go up to make you money. Gold does, silver does, palladium does. All those things have to go up to make you money. And you know, a piece of real estate doesn't. That example, that 25-year-old kid that did the right thing. I mean, that property, somebody else is making the debt service for him. And that's just such a wonderful thing. So you're not banking on appreciation. You're going to have the cash flow coming in. It's going to buy down equity. It's going to, you know, give you cash flow over time. You got leverage. You can leverage these investments, interest deductions, mortgage pay down, depreciation, appreciation. All those things are there with a piece of property. You can always look at it and understand you've got options. You've got ways to make that thing create value. And right now, you know, there's a flight to value, not necessarily as much a flight to value, but there's a flight to states that allow you to actually have some ownership rights. So, you know, a novel idea. You bought the property, it's yours. You should probably have some right of ownership and your ability to control it. So we're seeing lots of that. But, you know, the bottom line, real estate is the ultimate inflationary hedge. It's a wonderful tool. It's something I believe in wholeheartedly, and it's really given me a wonderful, comfortable life. Not without stress, but comfortable. So current trends, issues, what are people doing? I mean, you know, people talk about not completing exchanges, a failed exchange. We're in a situation where things are moving very, very quickly. You've got to look at what's happening. Any transaction, we're doing partial exchanges. People are buying the 45 days, just sort of figure stuff out, whether they're going to find what they want. They're increasing their portfolios, pick up other things. Other people are saying, hey, I'm done with rental houses, tired of the terrible T's, toilets, trash, tenants turnover. So they're going into DSTs, Delaware Statutory Trust, TICs, opportunity zones, that type of situation. We're also doing a fair number of transactions where we're combining qualified money with 1031 money to get people where they want to go. We'll give you a couple examples of that. That first bullet at the top, I just want to stress that that's something that's critical in today's world, and you got to understand when you're able to get money out of an exchange. And that's one of those issues. It's a big one when you're looking at an opportunity zone, for example, as a fallback, because the opportunity zone has the same 180-day timeline that 1031 does. So don't look at that 1031 and say, oh, gee, I'm just going to go through that 45 days and ID some properties. And now on day 50, you've decided, gee, I don't want any of those properties. I'm going to use the opportunity zone as a fallback. It won't work. We can't legally give you your money after that 45th day if you've got properties that are ID. So you've got to really look at this, understand that 45-day timeline, that ID period 1031 contains is the toughest issue with 1031, and it's probably more important today than ever before to understand what's going on there. But this lists just a few of the different issues we're dealing with regularly right now, and the biggest thing is timing. just because things go so quickly if it's good property, a good opportunity. This slide, I always put it out there. If it's up to me, every residential broker would throw that out on the table when they're out that listing appointment. If you're in the commercial world, you're going, gee, why do I care about Section 121? And I'll tell you why. 1997, when Section 121 came into being, it replaced Section 1034. 1034 was a rollover. 1034 said you got 2 years to buy a new home of equal or greater value. If you were 55 or older, you had a one-time lifetime exclusion of $125,000 in gain. That was replaced with the universal exclusion that said $250,000 individually, $500,000 for a married couple to qualify. It's a straight exclusion. You can do one every 2 years. For a property to qualify, you have to live in it for an aggregate of 2 out of the preceding 5. So if you're a broker, think about this. You go out a listing appointment, it appears like it's a rental house. You need to know, okay, was this how the taxpayer buy that property? Did they pull money out of the pocket to buy it? Did they roll over into it from previous properties? Did they do an exchange into it? How'd they buy that thing? Because that's going to change how things are looked. But if it's their home and they move out of it, just think of it from this direction. They got 3 years to sell, still taking the exclusion. So that property may appear, Section 121 applies to any property that fits a 2 out of 5. It's not what it is at time of disposition. 1031 applies exactly what that property is at the time of disposition. So you can convert a 121 to 1031, and you can go the other way too. It just takes time. Now, why I brought up 121 and 1997 is that 250 and 500 meant something in 1997 dollars. Today, think about the world and think about what properties are worth, primary residence are worth, and how many times you might have a situation, you personally might have a situation where your gains are well in excess of the 250 or 500 on your home. Well, are you stuck paying tax on the overage? Well, yes, unless you converted that property to an investment and then sold it within that 3 years of moving out, where you'd be entitled to take the exclusion and the overage would go into 1031. Now, if you're a commercial broker, the reason I'm bending your ear on this is if you've got somebody that's been successful in real estate and you've got a bunch of buildings there, they probably have a home that's in that same situation, gains in excess of 250 or 500, and you're going to help them keep their money theirs, and they're going to end up helping you by spending some of that money from that sale in investment properties. So an example I typically give in these presentations is a situation where we had someone with in excess of $3 million in gain on the sale of primary residence. We had them move out, convert the property into an investment. They sold it, took the exclusion. The overage went into 1031. They went from $1 million tax hit to zero and bought 24 different replacement properties. And I just think that's a great situation. And obviously they were very, very happy in that. 1031, we can convert it into investment. There's lots of reasons to do that. That's an end game. You want to go buy a place at the beach to retire into? We've got lots of people buying Florida right now for that specific purpose, or Arizona or Texas. I mean, it's just really interesting to watch because people are just done with some of these high tax states or low ownership or rights states. I mean, they're just done. So they want to go where they can actually control their destiny a little bit and keep their money theirs. But these two codes, what's going to fall in between these two? 1033, involuntary conversion. If you've got a property where it's being taken by a municipality, you've got a situation where you could go 1033 and it's more attractive than 1031. Similar rules in that situation. If 1033 is used via fire or some other act, then we've got a true like kind requirement. But if we're looking at, in this situation, we're just looking at the 1033 will say have the same rules basically as 1031 for like kind, but you've got a much longer period of time to replace what you're relinquishing. So since we're on the topic of seasoning, how long is long enough? How long do you have to own a property to have it qualify for an investment for 1031 purposes? And I hear 2 years out there all the time. 2 years applies to a related party transaction, but even a related party transaction, that's not an absolute. If you can show that there was no intent to avoid tax, even a related party transaction may not contain a required 2-year hold. But if we're looking at an arm's length transaction, there's no stated required hold in the code. 1 year's been proposed several times. through the years. And if you look at the break between short and long-term tax rates on assets held for investment, I guess I better use that example while we still have it. It also falls at 1 year. Now, this recent court case in this slide gives a court case where 4 months was deemed long enough that people bought a property, documented the advertisements, the showings. They moved into it after 4 months. They were audited, taken to court, prevailed in court after a 4-month hold. I personally, I wouldn't hang my hat on that transaction and that length of time. I'd like to see the year, but with that said, I've got lots of clients in just the last year that bought properties, and really it's what you're doing with it during the time you own it that's going to dictate how long you have to hold it. We've got 9 points used to determine dealer status. We're going to talk about those a little bit later. That's a different situation. But if you bought a rental property and the tenant's not paying you, or something else happened, you've got some illness, hardship, job changes, some hardship in life, you can justify a very short period of time there. You just want your tax people on the same page with you. They are your best friend in an audit. You want them happy with you. So really, once again, we're going to go back to that team, and that tax person is very important. You're going to talk to them. If you've got questions on timing, reach out to us. We'll give you the information. We'll arm you with some information. Go talk to your tax people. If they've got questions, they can talk to us about it. But 1031, as it is today, does not contain a stated required hold for an arm's length 1031 exchange. And like I said, even with related party transactions, which I believe is the source of that fallacy of 2-year required hold, even with a related party transaction, it's not an absolute. I like simple. So you've been in my classes, you've seen me with this. If I was talking about retirement accounts, for example, I've got 2, all right? I don't have 4, I've got 2. What's a person want to buy and who are they transacting between or for the benefit of? If I look at a 1031, I've got 4 main issues that I've got to look at. One, it's got to be an exchange. So you can call it whatever you want, but the bottom line is you're going to give us something, we got to give you something back. So something's given away, something's received. The items relinquished and received must be of like kind. Like kind requirements, very broad. It refers to the nature of the investment rather than the form. I've been told for many, many, many years, well, I remember when it's house for house, land for land. It's never been that way. It's always been this way. There's been proposals through the years. I think the last time we had a proposal to have true like kind was the late 90s. But the way it is, you can exchange out a rental house into land, apartment buildings, office buildings, a place to the beach to retire into. All those things are going to be of like kind. So any real property held for investment is going to be of like kind with any real property acquired with the intent to hold for investment. The third bullet point, the napkin test must be satisfied. What does the napkin test say? It says you must go across or up in value and equity between the relinquished and the replacement property. Now, a component of that that you don't see is debt. And I hear people say all the time, you have to replace debt in an exchange. Number one, 1031 is not all or nothing. But number 2, debt can go away 2 ways. One, by going down in value, and that triggers tax because you didn't meet the value requirement. The other way debt goes away is by adding cash. Now think about the world we're in, and you might be in a situation where you're looking at assets, you're looking at maybe your ability to get a deal done quickly. Loan to values in recessionary times, what happens? Loan to value decreases, equity decreases, and you've got a situation where quite often you've got to add money to the transaction. We're in a world right now where maybe just for the sake of expediency to get a deal done, you might buy it cash and then do a refi after acquisition, something like that. But you need to go across or up in value and equity. Now, it's not all or nothing. So if your target number is $1 million and the perfect replacement property is 900 and your basis was 500, well, that $900,000 property is still going to defer gain on $400,000. To be totally whole, totally deferred, maybe you got to get up that $1 million number. But that million is, if you sold it $1 million, you don't have to spend the full $1 million there either. I mean, you're going to reduce the $1 million by closing costs. So normal transactional costs, items like broker's commissions, title escrow fees, tax and legal fees, hour fees, current prorations, and property taxes. Those are considered normal costs. Lender required repair, for example, would not be, but it would be considered boot and taxable, but it's a closing cost. So your tax people should be able to mitigate any actual tax consequence on that reduction there. But what we're going to look at is a situation where, you know, you can offset mortgage boot with cash. You cannot offset cash boot with mortgage. Every dollar you spend more than you want to spend on something is going to cost you $1. If you don't spend it, maybe it costs you 30 or 40 cents. So understand what the tax liability is going to be at a certain spot, and then decide what you want to do. And if you are really adverse to paying any tax, obviously you need to meet that hard number. If the perfect property is less, you don't mind paying a little tax, you want to put some money in your pocket, fine, do that. As soon as the boot received exceeds the total amount of gain, then there's no benefit to the exchange, though. So I sort of look at it, and my little mind, I say, okay, what's the basis? Every dollar spent beyond the basis represents tax-deferred gain. And like I said, as soon as the boot received, anything that's not of like kind, as soon as the boot received exceeds gain, there's no benefit to that transaction. Now, number 4, continuity vesting. The taxpayer that relinquishes must receive. That's a lot easier said than done. And you know, the issue comes up in, for example, non-community property states, husbands and wives in limited liability companies all the time. Partnership interests are specifically prohibited from 1031 treatment. The partnership could do an exchange. So, for example, a multi-member LLC could do the exchange, but the members of the LLC, it's tough to go different directions. You either have to do a drop and swap or a swap and drop. We'll talk about that a little bit later. Those are industry terms. Timelines, 45, 180 days. Both start at settlement of the relinquished property. They go quickly. We've had a series of extensions this last year. We had them. I mean, I think the only thing we didn't have is a volcanic reaction last year, but we had fires, we had, you know, the flooding, we had, you know, hurricanes, we had COVID. I mean, all these things, presidentially declared national disasters, are typically receiving extensions these days. We've never had an extension for any purpose pre 9/11, but now they come out, and you just got to, you know, keep an eye on our newsletters. If you're in a situation, if you can prove you're an affected taxpayer, you're going to receive an extension in a lot of these situations. IDs, 3 different options. Identification, you only have to meet one of these. Keep in mind you complete the deal inside the 45-day ID period. You can do whatever you want. Actually, one other question, comment on that last slide. We go back. The 180 days, it's 180 days or the due date of the tax return. So late in the tax year, we've got to be very careful on that, because if you file your return prior to completing the exchange, you've just torpedoed the exchange. So really important that if you're doing transactions late in the year, that you complete the exchange prior to filing your tax return. So these 3 identification rules, you only have to meet one of them. First rule, up to 3 properties in value. Second, you can ID more than 3. Total value can't exceed 200% of the relinquished property's value. Third choice says you can exceed 3, you can exceed 200%. You've got to close 95% of the aggregate value of all properties identified. Now understand 2 and 3, that are B and C, those examples. You know, what are properties worth? And back, if I look back in 91, I had a copy of an audit manual, and one of the questions for ID was a property on the market at the time of identification? Well, that's a pointless question. I mean, whether a property is or is not on the market, define on the market. It doesn't have to be listed to be identified or bought. I mean, we've got people that buy things all the time off market. And by the way, like I said, what is on market? Do you have to have a broker to have a property on the market? So you've got to look at it and understand property doesn't have to be on the market at the time of identification, and you're just looking at an unambiguous description of what you're going to be buying. That could be a common address, including city, state, and zip. If you're buying a piece of something, you need to identify the portion that you're going to acquire. But you can make these identifications, change your time anytime, or change your ID anytime prior to midnight, the 45th day. After that date, without one of those extensions, there's no way to change your mind on that. So the other thing I want to just stress, back to my comment earlier on opportunity zones, is On that 45th day, I believe today it's more important than ever before. You're either totally committed to completing the exchange or say the heck with it. So if you're in a situation where you're on that 45th day and maybe you're a broker and you're working with the investor, and you say, well, hey, why don't we just put this down just in case? And imagine this, so they put down a property just in case, and now on day 60, you found that perfect property, the one they really want. Well, I can't give them the money to buy that property. And as I said with the OZ, if you didn't sync that transaction on the 45th day, rescind the identification, you can't get the money for that opportunity zone either. So at the 45th day, in today's world, you're either totally committed to completing the transaction or you should terminate the transaction and we can get you your money. And then you're free to go to the OZ or buy other things. But don't just throw something into that identification on that 45th day just in case, because it could come back and bite you in today's market. So that leads me to this slide. When can I get my money? Now, if we go back 20 years, maybe a little bit more than that, I can't remember when exactly the case came down, but somebody in our industry asked for rulings on this issue because honestly, they just wanted to hold your money. But the bottom line is you look at transactions, you look at when you're entitled to get money out of this exchange, and you can only receive funds per the 1031 G6 rules, which in a nutshell state, you can only receive funds after you've purchased all property you have the right to buy, which means you cannot get your money. If we set up an exchange, the money comes to us, and inside that 45 days, you decide you don't want to complete the transaction, we cannot give you the money until day 46. Now, if you've identified properties prior to the 45th day, and as I said earlier, you don't want any of those properties, you need to rescind the identification. So after the 45th day, if you've identified properties and we're now on day 60, for example, and none of those properties works out, it doesn't matter if somebody else has bought it, you would still have the ability to buy it. We could not give you your money until day 181. Now, the one exception is if there was an extreme material defect with the property or properties you identified. So, let's say they cooked the books, or let's say that you had a gas station and it, turned out they had a big old oil leak, something like that, where extreme material defect on the asset, then that would allow access to those funds. But short of that, if you've got ID'd properties on the 45th day, you're going to be married to us until day 181. So keep that in mind. Really work. If you're a broker, keep your people on the track, make them work to get where they want to go. If you're the investor, make sure you're hustling to get where you want to go. And by the way, start looking before you ever sell. People ask all the time, when do I want them to think about the exchange? I'm going to say when you contemplate a purchase, obviously, because depending on how you own that property, if a group of us go buy a property and we own it as a limited liability company 5 years from now, do you think we're all going to want it? And what do we have to do to go away? So understanding the ownership structure, planning ahead is a big, big issue, and it's very, very important when you're looking at real estate. You can't just stumble through life. Well, I shouldn't say that. I've got people that have stumbled through and made a fortune with the real estate, and I guess that's one of the benefits of it. You could do that, and it could work out wonderfully. But most of the time, hey, you really want to think about this stuff, plan ahead, make sure that you're not just doing stuff at the 11th hour, and make sure to ask those questions earlier rather than later. So warehousing transactions, this is not one of those basics, right? Warehousing a property means that we're owning a property for a period of time. Now, typically you're thinking of warehouse transactions from the context of reverse exchanges or improvement exchanges, but there's also transactions where we might take a property as consideration. If you look at the stack of assets or stack of things on a purchase sale agreement for the consideration for the purchase, it doesn't say total cash paid. It's a series of things, and it could be a property as well. It could be a car, and you're thinking, well, gee, a car's not like kind. I can't take a car as consideration for the purchase. Well, yeah, you can. Cash isn't like kind. It doesn't really matter. Whatever you're receiving as consideration is ultimately going to be ours. So what happens at that time of close is that everything used for consideration comes to us, and we're going to use whatever it is going forward. There's a section we'll talk about notes in an exchange, and we're going to talk about a variety of ways to use a note in an exchange. In reverse exchanges, they're really easy to use. But warehouse transactions are typically reverse exchanges or improvement exchange. A warehouse relinquished means we're taking ownership of the property that's going away. A warehouse replacement means we're taking ownership of the replacement property. An improvement exchange is really a warehouse replacement transaction where we're just going vertical. The same structure is used with a warehouse replacement reverse or an improvement exchange. So we're going to have the same concerns, banking concerns, different things going on there. A blended transaction, we might have a situation where we bought via reverse exchange, and so you've got 180 days from the date of acquisition to sell what you don't want, and then technically, if you had an overage, if you only wanted to use a portion of that money for the reverse, you could go forward for another 180 days from the date of disposition for the balance of that money. So that we would call a blended transaction, and that works very well for people. I think one of the brokers, I don't know if she's on this this webinar, but gal, her first exchange was actually two twins that were relinquishing 8 properties, and we got a series of them sold pre-disposition or pre-acquisition, and the balance of the properties came in via reverse exchange. So we combine all 8 into one replacement, and we use that blended transaction to get it done. So reverses, they don't give you any more time. Now, it's not an absolute. There was a case, Bardell, years ago where it looked like maybe they were going to open up on what the government was doing. But as I said, I've been doing this for a long time. Pre-2000, we got to the revenue procedure containing safe harbors for reverses in 2000. Pre-2000, we would do warehouse transactions. We also did what we would call a true reverse, and that I wish the government would have gone with that one because it's a nice, easy deal. A true reverse, for the sake of the conversation today, would be a situation where the taxpayer's on title to new and old property at the same time. So you'd go buy that, and you'd show up to purchase a replacement property with the cash necessary to buy. And by the way, we don't loan money. If you don't have the money to do a deal, we're not going to do this reverse. So first requirement of reverse exchange, you have to have the financial ability to get the deal done. So, if you've got the ability to get it done, we can go out and acquire that property. A true reverse would be a situation, you show up the purchase with the money, we sign a note saying that we've borrowed whatever was put down by you on that purchase property. We would buy it just like we would in any other transaction, give it to you, and then you'd have the 45 days to ID what's to be relinquished, 180 days to get rid of it. Now, they did not give us that option, so we don't do that anymore. What they did give us, at least for the safe harbors, is a warehouse transaction. So in the exchange world, we call it an EAT, an exchange combination title holder. As far as you're concerned, it's just a single member limited liability company that we're the member of. We create that entity to own a property. So you, the taxpayer, cannot own both the new and old properties at the same time. A warehouse replacement means that you're going to show up the purchase without money required to buy the property. We're going to close on it. We're going to own it in our LLC's name. We're going to own it until your property sells. When it sells, the proceeds from that sale come into us. We use them to repay the debt we've got to you. Any additional funds will be deposited, paying down the debt on that replacement property, and then we give you the new property. So the beauty of a warehouse replacement transaction is we can build on the property and we can pay down debt. So if you have less money available to put down on the property than what you expect to net from the future sale, we're going to do a warehouse replacement if possible. Now, the reason I say if possible is we've got lenders to deal with. So it really sort of has to do with what they're going to allow us to do if there's lending involved. Seller carrybacks probably solve that. If you're a cash buyer, that's beautiful. We can get that thing done. A warehouse relinquished means we're warehousing that relinquished property. So the lender's happy in a warehouse relinquished because they're just going to finance, instead of financing the property in the LLC's name, non-recourse to us, guaranteed by you and secured by the property, they can just go out and finance as they normally would. A warehouse relinquished is really what we would call also an exchange first transaction. Warehouse replacements exchange last. But in that warehouse relinquished situation, the lender's happy. You show up the purchase with the money required by. We buy the property, we give it to you, and simultaneously you deed the property over to us that's to go away. And it's held by our EAT until it goes away. When it goes, once again, we're going to take the proceeds from the sale, repay you what we owe you. Any overage would either be taxable to you, or you can go out and buy additional property. So once again, warehouse replacement is going to be used if you've got less money to put down what you expect to net, and we've got a willing lender. Warehouse relinquished is a situation where we need to look at the lending requirements and how much money's available to put down as opposed to coming out. So warehouse relinquished is going to work if you've got funds in excess of what your future expected proceeds are going to be from that disposition. And once again, a blended transaction might be, acquisition and 180 days from acquisition to relinquish. And then technically, if you've got overage, you could go forward via a delayed exchange and really stretch out almost to a full year to get the deal done. Improvement exchange, it's really the same structure as that warehouse replacement. So an improvement exchange, we cannot give you a property and then give you money to go vertical. Escrow holdbacks don't qualify either. So what you receive, when you receive it, has to be of equal or greater value and equity of what you relinquish for total deferral. When we're going to do an improvement exchange, I heard somebody describe it as the poor man's improvement exchange. Actually, one of my coordinators in here used to work for another company. She said, yeah, we called it the poor man's improvement exchange. I said, well, what's that? And really that was just their term for having the seller do the improvements. So if you've got something small, and I would say anytime you've got less than $30,000 in improvements, I wouldn't do an improvement exchange. You just pull the money out, pay the tax on it, and then go vertical as you need to, because the additional cost of the exchange is you're going from $1,000 to $1,500 to, we've got a base setup fee of $6,500 for reverse exchange, and then we charge an additional percentage, of what's going vertical on the thing. So they're a lot more expensive, but it's a great thing if you're doing, $30, $40, $50, $100,000 worth of improvements. That's great. If you're going to do 20,000 improvements, I'm just going to say, hey, take the money out, pay the tax on it, and you're going to be ahead. But the poor man's reverse is just to build the improvements into the purchase price, have the seller do the work, and then you're receiving a property that's improved and it accomplishes what you want to do. If the seller of that replacement property is doing an exchange, they're probably not going to want to do that because it's going to increase the numbers for them of what they're going to have to buy. If they're just going to sell and pay the tax, it really should have little to no tax implication for them, because you're doing capital improvements to it. So maybe you're looking at something that could be expensed or capitalized. You want to make sure that these things are, if you're getting to do that poor man's improvement exchange, you want that person to be able to do it without tax consequences. So, have them talk to us. We can talk about it. But typically, we're creating that same structure as a warehouse replacement. We're going to create the limited liability company, takes ownership of the asset. You're going to ID the property. You're going to ID the improvements to be done to it. And we're going to build the thing out, and then we're going to convey the improved property to you. It doesn't have to be complete, but only what is complete and constitutes real property is going to be of like kind and count towards the exchange. So the biggest issue we've got for improvement exchanges right now is time. I mean, if you're looking at the West Coast, for example, how long does it take you to get a shovel in the ground? And you might be, if you have not gotten started on this early and been working to make things happen, you might be halfway through the exchange period before you can get that shovel in the ground to go vertical. So it's really important, if you're wanting to do a traditional improvement exchange, do what you can, ask for whatever time you can, because you're going to have to be able to hit that ground and hit it hard and go vertical as fast as you can to get the improvements done within the 180-day timeline. We do something called a leasehold improvement exchange. That's a whole nother conversation, but that's a situation where you've got control of the assets in advance, so you can go out, get the plans, engineering, permitting, all that stuff done, and then when the properties sell, we can go vertical, or maybe we enter into that process sort of in a reverse improvement exchange scenario. We can get started. You're going to look at times of the year. I'm in Portland. The winter's obviously harder to build. We've also got hunting season that contractors seem to disappear during. I grew up in Santa Cruz, and it used to be high surf. The contractors disappear, but here it's hunting season or skiing season or just the weather and inability to get things done. But you really have to time the transaction if you're going to do an improvement exchange. Make sure you're asking for whatever time you can. to get things done. And it doesn't have to be, something brand new, ground up. A lot of times we might just be putting wells in, fence, a barn, something like that on big rural properties, or maybe we are building a new building. We've done swim and racket clubs during the exchange, the 180-day period. Obviously, in that scale of project, you're not going to get it done, but what we got done was enough to satisfy the exchange. And it's not all or nothing. So defer what you can. Every dollar you save, it gives you 3 or 4 more to reinvest. So it makes a big difference. Second homes. A lot of times people say, well, you can't do an exchange of second home. Totally untrue. We've always done them. We got the revenue procedure 2008-16 that gives you the rules for second homes. Remember when I talked about holding periods with arm's length and investment? I said there's no timeline. Second homes, we've got a situation where you've got restricted use for the 2 years pre-disposition, 2 years after acquisition. So basically for second home to qualify, you've got to restrict your personal use to 2 weeks or 10% of the time it's rented for the 2 years pre-disposition and the 2 years after acquisition. Now, if you look at a second home versus investment, what if you just stop using it entirely? What's it going to take to convert that to an investment property? I'm going to say, hey, just stop using it entirely, convert it to an investment, then do the exchange. And a lot of times we're in a situation where you're giving up an investment property, you maybe think you're going to buy a replacement property that's a second home, and in that situation, just restrict your personal use to no more than a couple weeks the first year. If you're there more than that, you're working on it, but ultimately you're having this conversation with your tax people. You want them comfortable with what's going on. And this is a topic that for 30 years I've been talking to tax people about. And before this Rev Proc, it was a longer conversation. Since then, it's really like, okay, hey, these are the rules unless we change the classification. What's going on with this? Exchange with related parties. We've got a lot of this. People want to do this right now. So we typically, you can sell to a related party. You should not buy from a related party. The exception would be if both you and that related party are both doing exchanges and you're both going to hold your respective replacement property for no less than 2 years. The exception would be if you can document there was absolutely no intent to avoid tax. So that's a tough one, because if you look at it, 1031, you got to argue, hey, I'm not avoiding its tax deferral, so that's not going to be the situation. So once again, sell to a related party be okay. Buying from a related party typically is not, unless both you and the related party are doing exchanges, holding your respective replacement properties for no less than 2 years, or you can document there was absolutely no intent to avoid tax. A conversation that you are going to have with your tax people once again. Partnerships, drop and swap, swap and drop. This is the biggest headache we have next to time. It's just so problematic. Partnership interests specifically prohibited from 1031 treatment. So the question is, how do we deal with this? And as I said, I would like to hear from people when they're going to buy a property, because I'm going to have this conversation. If a group of people are buying a property, I can say, look, tenancy in common allows you to do what you want when you want, where the partnership via limited liability company or any other legal partnership, you're in a situation where you've got seasoning issues. The partnership itself can do the exchange, but the individuals of the partnership could not go different directions. A drop and swap is a situation where we're going to have a deed from that entity to the individuals pre-disposition. Now, if you talk to me, I'm going to tell you, let's do it a year in advance. And we might actually have a meeting where we all sit down and talk about a year in advance. We leave that meeting, everybody's on the same page wanting to do that. And then a year later, I get to call the deals in escrow. I get a copy of the deed and it says it didn't happen. Well, I call them up and say, well, what happened? Well, we decided we didn't want to do it. It's time consuming and expensive. Think about what you have to do to liquidate a partnership. You got a whole series of things that have to be done. And 9 times out of 10 it doesn't happen. So what typically happens is this deed and the drop happens while the deal's in escrow. Now, it's not perfect, because how can you argue you personally held it for investment predisposition, but it's really, that's the only choice in that situation. So you're going to have the deed drawn from the entity to the individuals. You can amend the purchase sale agreement showing that it's no longer the entity selling, the individuals are selling. California is pretty active on this stuff. 2 years ago, the Federation Exchange Combinators annual conference and talked about it. They actually had the Franchise Tax Board California. We were blessed to have them in the presentation, and they basically said, hey, we don't want to see that. just rewrite the purchase sale agreement. We don't want to see something, basically showing that this change was happened. And with that said, that's sort of the information we're putting out. But really, this is a conversation that's a long one, and we need to have it. You need to have it with your tax people. You need to make sure everybody's on the same page. So a drop and swap is predisposition liquidation. So you're deeding from the entity to the individuals. The individuals are then going to sell. The purchase sale agreement's got to reflect that. The swap and drop is the opposite. We're going to do the exchange in the entity's name, or maybe we'll have that parent entity as the member of, if there's 5 different members, we might buy 5 different properties, one for each member, and each of those properties owned by a different limited liability company with the parent LLC as the member. And then a year downstream of the exchange, then you do an assignment of membership interest from the parent to the respective members. And that would be a transaction that works well. And the downside of that is a lot of times people are tired of each other, they don't want to go forward. Then you got lending issues too there, and it really just means you're all stuck together for another year. But that's the other option, and that's a good option too for you. But this is how simple this issue gets to be a problem. So at the bottom in the bold it says beware of LLCs containing spouse community property estates. So you and your spouse have a property, then you get another property, then you get another property, and then you talk to your tax people and your legal people saying, hey, gee, you've got all these properties, you got to shove them into an LLC. Now, if you're in Oregon, for example, non-community property state, you then sell that property, you want to do the exchange, you go to finance the replacement property, 4 units or less are considered residential loans. They can't be sold if it's in an LLC, therefore the cost of money is greater. Now you're upset with me because I tell you have to buy in the entity's name. Non-community property, we wouldn't have that problem. Community property with spouses, we have that issue. So this is something that's very important to understand, and we've got to look at it. And that's why the latest you want to get a hold of us as soon as you're deciding to sell something, get a hold of us and at least talk to us. But worst case, if you're closing tomorrow, we can still do the exchange for you, but we've got some things we might not be able to fix. Joint ownership, okay? So if we've got a situation where you want to go out and complete an exchange into a property, you want to combine that money with your IRA or 401k, that's possible. Normally, you could own a property jointly. So if you look at my 2 points at the beginning, it's what are you going to buy, who are you transacting between or for the benefit of? A transaction between or for the benefit of a disqualified party would constitute a prohibited transaction. You can't transact between or for the benefit of a disqualified party with IRAs and 401ks, but you can transact along with. Now, 1031, like I said, we're in a situation where partnership interests are specifically prohibited from 1031 treatment. So if you want to go into an exchange situation with joint ownership, it's going to require tenancy in common. The 1031 requires tenancy in common. The retirement does not. The retirement account, just joint ownership, you could do it as common members of an LLC or as tenancy in common, and each of those has ups and downs, but that's a conversation we can have. But we're doing a fair number of these, and really the only issue there is you've got to understand if you're going to combine qualified money with your tax money, it's got to be non-recourse debt. Notes in an exchange. All right, not seeing a lot of these right now, but I would expect, rates change, and maybe in games, you just want an installment sale. Instead of throwing the money in the bank, you want to carry a note. So these are 5 ways to get things done with a note. So think about that note. Earlier, I talked about a car or a boat, receiving it as consideration. When we sell a property and use a note, we're going to get the cash. The note, we're going to be the beneficiary of it, close, and then we've got to do something with it. So, if you got a car as partial consideration, you got to sell the car or use the car to acquire something, you just use it in the same situation, the same options are there. But with a note, we've got a choice. We can, first off, it's got to be hours at close. If it closes, don't call us if you've closed the property and you've got that note and it's now paying you off a balloon payment. You sold the property 2 years ago, now you're getting a balloon, it's too late, you're stuck. Another comment I've got to put out there is understand installment sales, you're going to have tax exposure on debt relief and depreciation recapture in the year of sale. So you better get enough of down payment to cover the tax on those 2 things. If you're just going to carry and to cover all the closing costs. If you want to defer everything, you've got a note. The note's going to come to us at close. We could then use the note and cash to go buy something. We could sell the note to a third party. most of the time our client buys the note from us. And you're saying, well, gee, why would I buy my own note? And the answer is pretty easy. What you're doing is substituting cash. That note's going to come to you. If you have a $100,000 note and $100,000 sitting in the bank, what are you getting on it? Nothing. That note could pay you 8%, 10%. You sold somebody in the cannabis world, could be 20%. So that note is a very powerful thing potentially for you, and that's an option. The other situation we're seeing more and more all the time is the property's not financeable, so a short-term note is there. So we just have the note come to us. As soon as the note balloons, we're free to go forward, completing the transaction with all the cash. So here's 5 ways to handle a note. Sell the note to third party, use the note to acquire replacement property, purchase note, short-term note maturing before the replacement property is acquired, or a partial exchange. You're just deferring the down payment, going to pay tax on the balance installment sale treatment-wise. We're actually through an hour. I apologize. We've got probably another 10 minutes to go. Notes in a reverse exchange. Notes in a reverse exchange I love, because remember, we're talking about reverses. You're going to show up the purchase with the money required to buy that property, the down payment. We sign a note to you for that amount of money, right? So if you came in with $100,000 to buy the property, we in effect borrow the $100,000 from you. Imagine you sell on a reverse exchange, and that consideration is a note. Well, we're just going to use that note to repay the debt we've got to you. So notes, when we're looking at reverse transactions, are very easily accommodated, and it's just it's a neat deal, and use it if you got that situation and it's going to make that perfect deal happen for you. Use it. But if you got questions on this, give us a call. Flipping property. Okay, we all see ads on TV. We all hear the ads on radio. I always love that one. Well, in your city, there's da 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 da. But bottom line, you're looking at 9 points that are used to determine dealer status. I use these 9 points looking at UBIT or UBTI in retirement accounts. So if you're conducting business, if you're flipping property, that's not an investment, that's a business. So if you want to use retirement money to go flip property, once again, it's a business. So you're going to be subject to unrelated business taxable income. Even if you have a Roth IRA, you're going to have that situation. But if we're looking from the 1031 context and what qualifies or does not, dealer property does not qualify. So if you're flipping property and all you do is buy the asset, fix it up, and then turn it, you're going to have a problem. Now, I was taught to flip properties in the late 80s doing, we would call it a modified flip. We'd buy the property, do the improvements. After the improvements were completed, we do a cash out refinance, keep the property for, let's say, a year or two. We take and re-leverage the money with the refinance money. Typically, the refinance money is equal or in excess of what you would have netted after paying taxes. And then a year or two later, you go out and do the exchange. The money that you got via the refi, you can use to live on, and then you can also buy additional property, and everything you buy with the refi money, the basis is the purchase price. So, we'll use an acquisition and a cash out refi after acquisition in a situation where maybe you have a debt-free property that you relinquished, and maybe for leverage it makes sense. But when we're looking at these dealer issues, if you've got a strike or two against you, I'm not going to lose sleep over it. Typically, dealers are going to have all these things, and you can be a dealer and you can also have investment property too. But the Clarkowski case says, hey, purpose for which the property is acquired, purpose for which the property is subsequently held, extent of improvements made, frequency, number, continuity of sales, extent, nature of transaction of the property, general business activities of the taxpayer, the extent of advertising and promotion of the property for sale, whether the property is listed with a real estate broker or other outlets, and 9, the purpose for which the property is held at the time of sale as opposed to the time of acquisition. The reason number 8 is there is if you bought a property and you got an offer that was too good to pass up, unsolicited offer, and that was maybe a month or two after acquisition, you could do that. But if you get lucky too often, you're establishing a pattern. The old comment, pigs and hogs, don't be the hog, right? You're going to have an issue. But for you to have a single situation where you bought something, historically you bought and held, and you bought something somebody else wanted, great deal, do it, but don't do it with the blessing of your tax people. Few examples. Okay, this is a situation where we had a gentleman giving up property, convenience store, and he went out, bought a restaurant, and he had some other stuff. But he really, when he first started looking at the acquisition, he wanted to self-direct his IRA, and he was going to combine the IRA funds along with the 1031 funds going forward. As I stated earlier, we've got to use tenancy in common if we're using a 1031 with IRA 401k funds. So we were looking at the TIC structure on the acquisition. Ultimately, he decided not to do it because the non-recourse requirement for using IRA 401k funds in real estate. So non-recourse, just for the sake of the conversation, means in the default, the only thing the lender can do is take the asset. They can't go after anything that you've got, anything that the IRA itself has beyond that asset. So cost of funds in that space is going to be a little bit more. You're going to have a lower loan to value, think 60, 65% typically at most. And they're typically going to want to see people that have experience in real estate, and they're probably going to want to see 15% or more in reserves. But this situation where we combined IRA funds and 1031 funds into a common investment. This is just an example. This is very common today. People are in the situation where they're just tired of a property or dealing with the tenants. Maybe they've had to pay too many of these fees that the cities or states are hitting them with on you know, eviction. But in this situation, they were giving up a $3 million apartment building. All they wanted was $1 million replacement property in the desert. And you're saying, gee, they went from a $3 million property to $1 million property. Yes, they did. They've got $2 million in boot. But their basis was $250,000 on the relinquished property. They still deferred gain on $750,000, saved them roughly $250,000 in tax. So get what you want to get. Just understand what the tax liability is going to be in that scenario. In the situation, understand the government has actually given us a path to do what they're talking about. So for you to buy a property with the intent to someday move into it, you're going to buy the thing, you're going to hold it for a period of time as an investment. That period is up to you and your tax people, but then you could convert the property into your primary residence. Don't think that, hey, I can hold it a year, move into it, live in it for 2, satisfy the exclusion, and sell it. We had a change around 2000 where a 5-year required hold got put in place. If you sold that property within 5 years of acquisition, it's a fully taxable sale. Furthermore, you're going to be subject to the Housing Assistance Tax Act of 2008, which is anything but assistance for taxpayers. All it does is stick it to us. What it says is that you can do this transaction, you can acquire a property via 1031, seize it as investment, convert it into your residence, and ultimately you can use the exclusion, but you're only going to be entitled to using the exclusion to a level where your exclusion is going to be attributable to the qualified use period, gain attributable qualified use versus a non-qualified use. So from 2009 to the date of conversion, that's non-qualified use. And then the time you lived in it is qualified use. So whatever the ratio of those two things, you're going to get the exclusion per that ratio. So don't do this thinking you're ever going to get rid of all the gain. You're never going to get the full 250 or 500. Use this structure if it's a place that you're going to spend the rest of your life. So this situation, just a transaction where we're taking a smaller building as partial consideration. Our client did not want that smaller building, so we warehoused it for him. That property was sold, converted to cash before we made the acquisition, getting our client whole and completing the transaction totally tax deferred. So once again, if we were to give our client that property and they were to sell it immediately, that would not have satisfied the exchange. Where that property came to us, just like that note came to us in the previous page, that property's coming to us, we're warehousing it until it goes away, until we've converted it to something we can use for the exchange. This is a situation where hopefully we don't go there again. If we've got massive inflation, at some point this economy is going to slow down. If it slows down, we might have a situation where you've got problems. You might have a situation. We had a huge, we had like a $70 million markdown on a debt on a, with the hospitality world's just got crushed this last year, obviously. So the company that owned the asset was going to lose the asset, but they got the debt marked down, so that took care of their problems. But that was a big markdown, that situation. But we might have people losing to properties foreclosure if their tenants aren't paying. Maybe you've got retail that's now empty, or maybe you had hospitality that nobody's going to see or use, or whatever it might be. Well, understand, in a residential foreclosure, you've got tax relief. In commercial stuff, you don't. You're going to be subject to what's called phantom gain. So in a foreclosure of an investment property, if the debt exceeds the basis, that's phantom gain. The debt is treated as a sales price, and you may lose the property, lose everything, and have tax exposure in that scenario. So in this transaction, what happened, this was an institutional offering, a series of limited liability companies, tenancy in common, pre-foreclosure. The membership interest was assigned over to us. That started the clock on the exchange. The foreclosure date did not. So when that property was transferred to us, that started the client's 45th and 180th day. And understand that in a lot of cases, the loss to foreclosure and the tax consequence of that loss may be in excess of what you might have to come out of pocket to go buy something. So the exchange might ultimately be the cheapest option for you going forward. But really, you need to understand what's going on, and we have to be in place pre-foreclosure. In this situation, the assignment happened pre-foreclosure. The property went away in a foreclosure, and we actually took this person from a pretty substantial tax hit to none. They got a property out of it. And understand, in this situation, the debt was non-recourse to the taxpayer, allowing them to get where they wanted to go without that damaged credit and inability to get a loan. This is a transaction where we gave up a property. Our clients, very, very active investors in this situation, a tenancy in common offering, property went away, and the tenancy in common had both qualified IRA 401k TIC members and also the tax TIC members in it. What we did was upon disposition, we took and isolated all the qualified money. The IRA 401k money went off to the side. We completed the exchange for just the tax money, the people that needed to go forward, the people that had tax ramifications on that disposition. And we used the IRA, the 401k IRA funds for debt going forward. So what happened is the TIC went forward, completing the transaction. This was actually an improvement exchange. So we did improvements on that property using the qualified money coming in as debt. On this transaction, those people ultimately wanted to be members or owners of that asset in the future. So what ultimately happened is a year, 2 years later, after the improvements were done, everything was stabilized. The qualified money, the note for those people was actually converted to a membership interest in the LLC. And now we've got a situation where the TIC members contributed their interest to the LLC, received membership interest attributable to their equity, and at the same time, those notes were contributed by the qualified funds. Now we have everybody owning this asset via the limited liability company as they ultimately wanted to. Now, this is a group that is very good at this stuff, and so ultimately this thing will be dropped back into a tenancy in common predisposition in the future at some point, unless everybody's choosing to go forward via that entity. But that's the typical MO in a situation like this. This is a total curveball. Doesn't have anything to do with exchanges. I just want to show you what's possible if you've got IRA 401k funds. Elderly couple came to us. They said, we want to use our IRAs to go buy this mobile home park. So we started talking about what's called a checkbook IRA, which would have gotten them there. Then they told us they wanted to live there. They wanted to be the on-site manager. So what we ultimately did is shifted gears into what's called a rollover business startup. We moved both their IRAs into a 401k plan. The 401k plan bought into a C Corp. It has to be a 401k plan, a C Corp. The C Corp bought the park and employed them as the on-site managers. They got an investment, they got a job, and a place to live, all with that transaction. I like that. It's pretty neat. End game: swap till you drop, exchange into a retirement residence, exchange until it makes tax sense. What are they talking about with capital gains? So keep an eye on that one. Exchange into a passive investment, DSTs, UPREITs, tenancy in common, maybe something else, but those are the typical courses. Installment sales, structured sales. So installment sale, understand what your tax liability is going to be in the year of sale. Structured sales, an institutionally structured installment sale, a charitable remainder trust. Those things are great. Opportunity zones are going to be there. Gifting. Comment on gifting. Understand if you gift a property, you're gifting all the equity in a property. So you got to understand where the gift tax limits are and really talk to your tax legal people. If you've done estate planning, make sure you're not triggering a huge tax hit if you're the person granting that gift. But we have lots of people that will go out and buy multiple properties, each property ultimately ends up gifted over to a kid, let's say. But that happens all the time, and it's a great opportunity for people. We've got, as I said earlier, Equity Advantage has been around since 1991. We've got our retirement company, IRA Advantage, a dozen years old. Got a property posting site. If you're looking for something, if you're a broker that wants to get something in front of our people, just go log in at post1031.com. It's free to list properties. You can put stuff up there. There's a Have One section up there too. If you want to be on our newsletters, please contact Celia at Seymour at 1031 Exchange, and she'll take care of you. This recording will be up on YouTube, probably be up later today. So if you missed it, or if you've got friends that you'd like to have see it, they're going to have access to it going forward. And please get out in front of your clients too. If you're a broker, if people have questions, this is the best way to handle stuff. And we're happy to answer any questions you might have. Here's our social media sites. Thank you very, very much to everybody for joining us on this St. Patrick's Day. Hope you're wearing green so you're not getting pinched. I don't know how PC getting pinched is these days, but that's the world we're in. Thank you once again. This is David Moore with Equity Advantage, 1031exchange.com. And we are the guys with the answers. And all my best of health to everyone out there. And I look forward to talking with you soon. Take care. Bye-bye.